Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 164 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think can be useful for you in your long-term financial journey. Today, we are going to be talking about why your investments can't go to zero, and I'll explain what I mean throughout the course of this episode. It may sound countercultural, it may sound absurd, it may be against all the fear mongering that you see on the news and maybe even on some finance channels, but the idea that your investments can go to zero is such an absurd idea if you have a proper portfolio that I thought I just had to address it in a video. But before we get started, if you could go down below, hit the big red subscribe button, like this video, leave any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, then be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to keep you accountable to a plan over the long term and create a plan that is specific to you and your family's needs, I can do that. Just go to my website, www.mnowithdylan.com. You can click on the Work with Dylan tab, and then you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. Now guys, trust me, as millennials, we have seen it before. We have seen the stock market crash. We have seen it crash multiple times, right? Many of us have been around for the dot-com bubble. Many of us have been around for the financial crisis. Many of us have been around, well, all of us likely have been around for the COVID crash, right? We have been around for all of these different stock market crashes, and it scares many people out of the market. It scares many people out of investing for the long term. It scares many people out of allowing their money to work for them over the long term and compound into more and more money and a larger and larger nest egg. And this is a shame. It is a shame that we allow volatility and we allow uncertainty to push us out of the game altogether. And my argument today is multifaceted, but my argument is that if you have a proper investment portfolio, your investment should never go to zero. And I know that may blow your mind. You may think, oh, well, there's got to be some chance that everything that I invest goes to zero. I'm sure there is some chance, but that some chance is so extremely slight and so extremely extreme, right? It is so extremely out of the realm of possibility that I don't even think that we should take it into account, right? We shouldn't even take into account the fact that everything could go to zero, because at its basis, and at the basis of financial markets, if everything went to zero, if every investment portfolio went to zero, then our society as we know it would fail to exist. We would no longer have, one, a capitalist society, two, we would not have a financial system in which companies could go to the market to raise money for themselves. Three, there would be no companies that have any public access to financing. The people couldn't finance companies either by debt or by equity because we wouldn't be able to buy bonds or buy stocks, right? There would be zero demand for that and likely zero supply of securities for us to invest in. It would be a very much apocalyptic type of outcome at its basis, right? If everything went to zero, then that would be what the world around us would look like. We would have much bigger issues than our investment accounts going to zero. We would have bigger issues of needing food and water, and right. It's an apocalyptic scenario. It is a very, very extremely unlikely thing to ever occur. Okay, and I don't mean ever as in we'll never get to a point. Obviously, as a Bible believing Christian, I believe that yes, everything eventually will be flipped on its head. There will be a time, but again, we've got bigger things to worry about if that time actually comes. This is not something where, you would need to find another way to invest your money. No, you wouldn't even be worried about the fact that you had money in the first place. So as long as the system as we know it continues, things going to zero in broad amounts, right? In a broad sense is extremely unlikely. Now, you may say, well, isn't it likely that some individual investments, maybe not, everything all at once, could go to zero. Well, yes, that's exactly true. And we know this because every year, right, we see companies go bankrupt. And whenever a company goes bankrupt, their stock, right, and I mean liquidate, go bankrupt, right? They really go under. Their stock becomes worthless. Their stock no longer exists. Their debt becomes relatively worthless. Now, their creditors get paid off to a certain extent, as much as they can get paid off with the money that the company can come up with upon liquidation. But other than that, they are left with extremely little. And so your returns, especially on the stock of those companies, would turn out to be negative 100%. You could lose everything, and that is if you held it all the way to the bottom as well. We're talking about individual companies that not only did you invest in, but you held them all the way to zero. You held them without ever selling them, right? We're not talking a 90% loss even. We're talking about holding it all the way to zero. And many people wouldn't do that. Many people would see the writing on the wall. They would, realize that bankruptcy was likely and at least get out with some semblance of some negative return, right? Maybe it is negative 90%, but that is better than losing it all. But it's definitely possible. It's definitely possible for individual securities to become worthless. It is possible for individual bonds to become worthless, right? Because if the company isn't paying, right? If the company doesn't pay the bondholder, then the bondholder doesn't get any money. And there can be a total loss on an individual bond. And so when it comes to individual securities, individual things that rely on individual companies, then yes, your investments could go to zero, right? But why did I say at the outset that a proper investment portfolio shouldn't go to zero? Well, because a proper investment portfolio should encompass two different ideas, right? It should encompass, one, the idea of diversification, and two, the idea of asset allocation, okay? And so if we just want to start with the idea of diversification, we can start by looking at the S&P 500 over time, because the S&P 500 is a diversified group of stocks, right? It is 500 approximately, right? We've talked about it may be a few more or a few less at any given time, but it's about 500 companies that are from the United States. They're large companies, right? But they're in all different types of sectors, right? You've got energy companies, you've got technology companies, you've got healthcare companies, you've got all these different types of companies all within this broad index. And so they don't move perfectly together, right? The performance of these companies does not necessarily rely on the performance of all the companies together, right? They all have different business models for the most part, and they do different things to make their revenues. And so if you invest in the S&P 500, this broadly diversified market index, and I say that this is broadly diversified, this is only large U.S. companies. If you buy a more broadly diversified index, something like a world stock index, where you're buying an ETF or mutual fund that tracks not only U.S. companies, but companies that are internationally located, and not just large companies, but companies of all sizes, that is an even broader diversification from just large U.S. companies. But even the S&P 500 is very good diversification relative to most investment portfolios. Now, the S&P 500, like I said on the outset, we have seen it fall hard many times, right? We have seen many bad years. We've seen many negative dips. We've seen many crashes, right? And even though we have seen all those crashes, the S&P 500 has still been extremely resilient. We have seen times when we felt like the world is coming to an end, quote unquote, right? But it hasn't happened yet, right? It hasn't happened yet. It hasn't happened, especially in financial markets. And let's just think for a moment critically, right? Let's think for a moment about what the S&P 500 represents, what a broadly diversified market index represents. Well, what it is going to represent, right, is all of these great companies, especially with the S&P 500, because we're talking about large U.S. companies with the likes of Apple, Amazon, Google, Berkshire Hathaway, Facebook, all these amazing U.S. companies that are, very heavy in this index. And you have to ask yourself, are all of these companies going to cease to exist? And of course, the answer is no. The answer is No, all these companies will not cease to exist, at least not all at once, right? And again, if they do happen to cease to exist all at once, we have much larger problems than where our investment accounts went, right? But are these companies in a likely scenario, when we're talking about just probabilities, are they going to cease to exist all at once? And the likelihood is absolutely not, right? Now, will some of them cease to exist? Of course, we have seen it over time. Some of the largest companies in the United States have fallen before. We've seen Lehman Brothers file bankruptcy, right? That was a very large investment bank back in the 2000s. We have seen companies like Enron, who were fraudulent in the way that they were doing what they were doing over time, and they ceased to exist, but they were one of the largest companies in the world as well. So will individual companies cease to exist? Yes, and that's why I was talking about if you just own one individual company, then the likelihood that your investments go to zero is far higher than your investments going to zero if you own some broadly diversified index or some broadly diversified group of stocks or other assets. So this very bold statement of your investments can't go to zero, and here we've been talking about the S&P 500, right? What is the worst that the S&P 500 has done? Right? What is the worst we could have seen from the S&P 500, from these 500 companies? Well, if you look at the last 100 years, the worst year that the S&P 500 has had in the last 100 years was 1931. And in 1931, the S&P 500 fell 47.07%. Yes, that is a huge drop. Now, we've seen larger drops than that within years, right? The financial crisis brought us a larger drop than that. The bursting of the tech bubble brought us a similar crash in the way of 47%. But that particular set of years in 1931, the 2 years prior and the couple years after, we were talking about the Great Depression. The Great Depression was occurring during these times. And so not only did we have a negative 47% year, 1929 was a negative 11.9% year. 1930 was negative 28.48. Then you had the negative 47% year. Then 1932 was negative 15.15, right? So it was just a bloodbath. It was a slaughter of the market for those 4 years. Then obviously, you get to 1933, the market jumps almost 47% out of the gully that it was in. But we have not seen a worse calendar year than 1931, and that was being down 47%. Okay, and that group of years is the closest we've come to everything being worth nothing. But if you know market history, you also know that before those couple of years, these stocks were broadly overvalued on a wide scale. They were overvalued in a crazy amount. There was mania, right? And we are not immune to mania ourselves. We have poured our money into lesser things, right? We still do that to this day. We pour money into the GameStops of the world. We pour money into Bitcoin, and we pour money into all these things that we think are going to the moon, right? And whenever you hear to the moon, run back to your house, right? This is not what you are looking for as a long-term investor. But we are not immune to mania. We know that mania occurs, and mania can lead to huge declines in stock prices. But that does not mean that they are going to zero. In our lifetimes, in my lifetime at least, right, the worst year that we have seen is 2008, which was negative 38.49%. But we know after 2008, we came out of that into a raging bull market for the next 11, 12 years. Some would argue that we are still in that bull market if it wasn't for the coronavirus pandemic. So we know that these crashes have occurred, but we haven't gone to zero, right? We've seen wars and we haven't gone to zero. Think about how many wars in the last 100 years the United States has been a part of, and yet we haven't gone to zero. Think about how many different economic downturns, how many different recessions have occurred in the last 100 years. A lot, and yet the economy still stands up. The economy is still running. Now, it runs differently than it has run in the past, but it has adapted. It has adapted to the way that things go, the way that policy is made, the way that individuals can make money, the way that regulations are. But We've seen negative years, but we've seen far more positive years. And that is why if you look at the long-term returns of the S&P 500, if you look over the last 100 years at the S&P 500's returns, right? If you would have reinvested your dividends, right? So you would have just invested in the S&P 500 and reinvested your dividends over the last 100 years, you were going to make 10.696% per year. Okay, so compound that out. That can turn into a huge pot of wealth, right? A 10.69% per year return can turn into a lot of wealth over time. And so this 10% rate of return has been broadly consistent, especially over the time periods within the last 100 years. There have been some time periods that have slouched a little bit more. The 70s were slouches. The 2000s were slouches, but that does not mean that your investments are going to zero. That does not mean that you are even going to lose money over the long term. Because if I asked you the simple question of if you took those companies that I named earlier, if you took Apple, Amazon, Berkshire Hathaway, you took Facebook, you took Google, you took Netflix, you took all these companies, right? And I asked you that over the next 20 years, as a group, do you think they will go up in value or down in value? Well, over the next 20 years, you would say probably go up in value. And if that is not reason enough to buy a broadly diversified index, I don't know what is. I don't know what would be the reason why you wouldn't buy a broadly diversified index. People are so afraid of short-term volatility. They think that just because their investments have gone down in value, that they have lost money. You don't lose money until you realize the losses, right? You don't lose money until you sell. And when you sell, then the money is gone. Then the money is out of your account for good, right? But if you continue to own the same thing, the value of that thing is going to fluctuate over time, right? The funny thing is we don't worry about our homes or our other assets in the same way, right? Our home is the other large appreciating asset that we own as a group. A lot of people do own homes, and homes are seen, they're an appreciating asset. You can finance them at a low rate. And they're going to go up in price over time. This is what we look for when we are purchasing a home. We want a home that will increase in value over time and that will be a good place for us and our families to live. Well, when we buy that home, we're not constantly looking at the value of the home, right? You're not looking every day or every week or every month at what the value of that home is. And you're definitely not going to sell your home because it has gone down in value, right? You're not going to sell your primary residence just because it has gone down in value and because you're scared it will be worth zero, right? Because how illogical would it be to think that that asset would be worth zero? Well, then think even further. How illogical is it to think that 500 of the United States' best companies will be worth zero, right? So treat your investments like your home. Treat your investments like other things that you buy throughout the course of your life. If you were to go and buy a farm, right? You're not going to, and this is a Warren Buffett example he uses all the time, but I'm going to steal it for the sake of this video. If you were to buy a farm, you're not constantly going to look at the price of that farm. You're not constantly going and asking for that farm to be reappraised and reappraised and reappraised just so you can see what the price of the farm is. And you're definitely not going to sell the farm when it is worth less than what you paid for it, right? You're not going to sell the farm because you're afraid that it's going to be worth nothing. You would hold the farm, right? Because you believe it would go up in value over time, and most land does. Most appreciating assets like that do. Well, guess what? Stocks, these companies, it's not just fairy dust. It's not just something that's fake, right? These are actual assets. You are buying the assets that these companies hold. As a part owner, right? When you're buying shares of stock or you're buying an index, right? You are a part owner in the companies within the index. You are a part owner of these individual companies. And as a part owner, you have a right to the company's assets and the company's income, the company's profits. And in having that right, you will benefit from the appreciation of those assets over time. So to think that these things in a broad sense can go to zero, I understand the short term, right? And I understand the buying one stock and that stock going to zero, I get it. But to think that broadly stocks are going to go to zero is just an illogical thought process. And I wanted to break it down for you because I think it keeps so many people out of the game. It keeps so many people out of investing for their future. It keeps so many people out of doing something as simple as buying an S&P 500 index fund. They won't even do that because they believe that there's a likelihood that their money will completely be lost. Well, the S&P 500, like we just saw, right, over the past 100 years, is averaging over a 10% return per year. Not only is it averaging that type of return, if you look at the number of 10-year periods that have been negative, right? If you look at rolling 10-year periods that have been negative over that course of time, you will find 3 out of like 90, right? If you look at a 90-year period, you will find like 3 years. I've seen this stat before. I think the data was from 1926 to 1916. It was a First Trust report that was printed out, and it was talking about 10-year rolling periods. And you look at a 10-year rolling period, meaning if you looked from 2000 to 2009, that's a 10-year period. But then a rolling 10-year period would be, okay, 2000 to 2009. Then you look at 2001 to 2010. Then you look at 2002 to 2011, right? Rolling periods. Out of those 90 periods that there were within that study, 3 were not positive, right? So you had 87 positive 10-year periods out of the 90. I think that is reason enough to be investing in something as simple as the S&P 500. Now, that is a long-winded example of why your investments can't go to zero, but that's just a diversification example, right? There's also the idea of asset allocation. The primary way that we can de-risk our portfolios is via asset allocation, not just diversification. Again, diversification is taking a specific asset class, so stocks, right? And buying different stocks, different types of stocks, different sizes, different sectors, things like that, right? That's diversifying. But to employ asset allocation, that means we are buying differing assets and we are putting those in our portfolio. So we're buying things like bonds, we're buying commodities, we're buying precious metals, we're buying these different types of things that we can invest in. We're buying real estate to put in our portfolio, right? And the reason that we would do this and the reason that this decreases risk is because different asset classes are not perfectly correlated with one another, right? You have differing asset classes that are going to move differently, that are going to work differently. The bond market is not going to move just like the stock market. The stock market is not going to move just like the real estate market. The market for gold or the market for even something like Bitcoin is not going to move the same way as the stock market or the bond market or things of the like, meaning that their value is not derived from just the same place that the value for a stock is derived or for a bond is derived, right? And so given that that is the case, that is going to decrease the likelihood that everything that you own goes to zero. Why do people buy gold all of the time, right? Why has that been a big thing? And why are people nowadays flocking to something like Bitcoin? Well, the reason, broadly, right, other than people flocking to Bitcoin to try to make a quick buck, the reason was that they wanted something that was going to be apart from the system. It was going to be decentralized, right? It's going to not be a part of our traditional financial system. And in doing that, in moving away from the traditional financial system, that means that the value of whatever that is not reliant, whether it be gold or Bitcoin, on just what happens in the financial system. We've talked before how these things are heavily reliant on the ideas of supply and demand, and there's not much underlying asset value apart from supply and demand. But nonetheless, these are ways that you can be employing asset allocation to allow yourself to take risk off of your portfolio, right? Even if something like Bitcoin or gold or commodities or whatever may be more risky by themselves, to add them to a portfolio, at least in small part, that is heavily stock or bond weighted, will allow you to add a little mix in to where there's not as much correlation between the assets, meaning you're likely going to have less in the way of volatility within your portfolio. And that's the whole idea, to take risk off. Now, again, we aren't talking about just losing money, right? We're not talking about just down years. We are talking about, can your investments go to zero? And a diversified portfolio, right, if you have something like Ray Dalio's quote unquote all-weather portfolio, where you're buying long-term bonds, you're buying short-term bonds, you're buying stocks, you're buying commodities, you're buying gold, all these different things in a portfolio in differing percentages, right? Is that portfolio going to go to zero? Again, unless our society collapses, absolutely not. Now, does that mean that returns can't drag for some period of time? Of course, returns can drag for some period of time. We were just talking earlier about the Great Depression and how returns dragged for several years. And if you're an investor, that's got to hurt. It's got to push people out of the market that are irrational. It's going to push people out of the market that don't believe that the market can rebound. But what have we seen since the Great Depression? We have seen a century of economic success. We have seen a century of stock prices increasing, of the value of our economy, the value of companies within our economy increasing, the value of commodities increasing, the value of precious metals increasing, all these things increasing over time, right? Not decreasing, and not only not just decreasing, not going to zero, not becoming absolutely worthless on a broad scale. So what do we learn? What do we know? What do we find out today about our investments, or about our lack of investments, that may lead us to say, hey, we actually need to be investing? What we have learned is that our investments are not going to zero unless something absolutely catastrophic in a way that we've never seen before will happen, right? Until our society collapses, there is not going to be such a broad overhaul of our financial system that everything we own goes to zero. It is just not the case, right? And to think that it may be the case is to be on the wrong side of a winning trade. To be thinking that your investments can go to zero at any given time is so illogical that it is going to lead you to the wrong side of the trade. It is going to lead you to things that are not going to earn you much money, or that may not earn you any money at all. It's not going to allow you for your money to compound. It's not going to allow you to build wealth in the same way that many others would. It's not going to allow you to create as much income for yourself in retirement as could be possible otherwise. It's not going to allow you to take the returns that are easily offered by the market and make them your own, because you are so afraid of something so illogical. So what's the takeaway from today? If you own a diversified portfolio, right, or a portfolio that takes into account broad asset allocation, the likelihood of your portfolio going to zero is basically zero, right? It trends towards being 0% probability of your portfolio going to zero. So keep that in mind, and don't let it keep you from investing. If you're so afraid of investing that you're just sitting on the sideline, or so afraid of investing that you're just putting your money in a savings account, look, I understand. Learn some though. Understand the history. Understand the likelihood of things occurring, and especially take a long-term view, because over the long term, things have panned out pretty darn well for those who have bet on the stock market and bet on companies going up in value over the long term. And if that is the basic thesis, that in a broad sense companies are going to go up in value over the long term, then you know where my money will be, and I hope that you'll join me in that place, the stock market. So thank you guys for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below if you haven't done so already, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, then be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to create a financial plan specific to you and your family's needs and keep you accountable to that plan over the long term, then I can do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. Now, our investments may not be going to zero, but tomorrow, if you tune into tomorrow's episode, we're going to talk about the times in which investing should stop completely. And there are a few times when investing should stop completely in your financial life. So tune in tomorrow to hear more about that. So thanks for tuning in to today's episode of Money's No Object. I'm your host, Dylan Howell. God bless.